Welcome to Cashflow Positive, your go-to channel for all things finance. Today, we're embarking on a thrilling journey towards financial independence by learning to build a dividend stock portfolio. This investment strategy, when done right, can create a steady stream of income and provide a safety net for your financial future. So, whether you're a seasoned investor or just starting out, this step-by-step tutorial is for you. Stay tuned to learn how to step-by-step build your own dividend stock portfolio. Before we dive in, it's crucial to understand what dividend stocks are. So let's unravel the mystery. Dividend stocks are shares in a company that pays out a portion of its earnings to shareholders, which is you, in the form of dividends. It's like getting a slice of the company's profit pie purely for owning its stock. Now the question arises, how do these stocks work? Well, when companies earn profits, they have two main choices. They can reinvest these earnings back into the business for expansion or other ventures, or they can distribute a part of these earnings to their shareholders as dividends. Some companies may even choose to do both. The frequency of these payments can vary. Some companies pay dividends quarterly, some semi-annually, and others annually. The amount you receive depends on how many shares of the stock you own and the dividend rate set by the company. So why should you consider investing in dividend stocks? There are a few compelling reasons. Firstly, they provide a steady stream of income, separate from the potential gains or losses of the stock market. This can be particularly attractive for those looking for some financial stability or a passive income source. Secondly, they can act as a cushion in volatile markets. Even if the stock price drops, you'll still receive your dividend, mitigating some of the loss. Lastly, reinvesting these dividends can lead to exponential growth over time. This is thanks to the power of compounding, where your dividends buy more shares, which in turn generate more dividends, and the cycle continues. However, it's important to note that not all companies pay dividends. Typically, well-established firms with stable earnings are more likely to pay dividends, while younger, high-growth companies may reinvest all their profits back into the business. Now that you have a grasp on what dividend stocks are, we can move on to the first step of building your portfolio. The first step in building your dividend stock portfolio is setting your investment goals. This step is as crucial as the foundation of a building. Without a clear and strong foundation, the entire structure can crumble. So what does setting investment goals entail? It's about defining what you want to achieve with your investments. Do you plan for a comfortable retirement, or is it about generating a stable income stream? Having clear, realistic goals will guide your decisions and influence the choice of stocks. For instance, if your goal is long-term growth, you might lean towards companies with a proven track record of steady dividend increases. On the other hand, if you want immediate income, you might prefer stocks with high current dividend yields. Remember, these goals are not set in stone. They can evolve as your financial circumstances change. But having a starting point is essential. Once you have your goals set, you can begin the process of selecting your stocks. The next step is selecting the right stocks for your portfolio. When it comes to choosing stocks, there are a few key factors to consider. First and foremost, you'll want to look at the financial health of the company. Are they profitable? Do they have a strong balance sheet? Companies in good financial health are more likely to pay dividends consistently and less likely to cut them in tough times. Next, consider the dividend yield. This is the annual dividend payment divided by the stock's current market price. While a high yield can be attractive, it's important not to chase yield blindly. A very high yield can sometimes be a sign of a company in distress. The payout ratio is another crucial factor. This is the percentage of earnings a company pays out as dividends. A lower payout ratio can be a good sign, as it may indicate the company has room to increase its dividend in the future. However, it's important to compare this ratio to other companies in the same industry, as what's considered a good payout ratio can vary. It's also wise to consider the company's dividend growth. Companies that have a history of increasing their dividends are often a good bet, as they're likely to continue that trend. Look for companies with a track record of steady dividend growth over the past 5 to 10 years. Lastly, don't forget about your personal investment goals and risk tolerance. If you're a conservative investor, you might lean towards established companies with a history of stable dividends. If you're willing to take on a bit more risk for the potential of higher returns, you might consider younger, growth-oriented companies that have recently started paying dividends. Take the time to do your research. Read company reports, follow financial news, and consider using an investment advisor or robo-advisor to help you make informed decisions. Remember, the goal is to select stocks that align with your investment goals and risk tolerance. Once you've selected your stocks, it's time to diversify your portfolio. Now, you might be thinking, why diversify? Well, diversification is the financial equivalent of not putting all your eggs in one basket. Imagine this scenario. You invest all your money in one company's stock. If that company's stock price plummets, your entire investment takes a hit. But if you invest in multiple companies across different sectors, the poor performance of one stock can be offset by the good performance of others. That's the beauty of diversification. It helps manage risk. So, how do you diversify? There are a few strategies to consider. First, consider investing in different sectors. If you've invested heavily in tech stocks, maybe it's time to look at healthcare or consumer goods. Second, think about geographical diversification. Don't limit yourself to companies in your home country. Explore international markets. This way, if one country's economy is struggling, your investments in other countries can help balance things out. Finally, consider diversifying by company size. Investing in both large cap and small cap stocks can provide a nice balance. Large cap stocks tend to be more stable, while small cap stocks offer the potential for higher growth. Remember, diversification doesn't guarantee profits or protect against all losses, but it can help you manage risk and build a more resilient portfolio. And that's what we're aiming for, a portfolio that can weather the ups and downs of the market. Diversification is key in building a robust dividend stock portfolio. You've built your portfolio, but the work doesn't stop there. Indeed, the journey of your dividend stock portfolio is a lot like sailing. You've chosen your vessel, stocked it with an array of different stocks, and set your course towards your financial destination. But the sea of the market is ever-changing, and to stay on course, you need to keep a keen eye on the horizon and adjust your sails accordingly. Regular monitoring of your portfolio is crucial. It's not about obsessive, minute-by-minute tracking of each stock's performance. That would be like trying to steer your ship based on each wave. Instead, it's about understanding the broader trends, the shifting winds and currents of the market. Are your stocks performing as expected? Are they aligned with your investment goals? These are the questions you need to ask regularly. Adjusting your portfolio is equally important. Sometimes, you'll find that a stock isn't performing as anticipated or that market conditions have changed. When this happens, it's time to adjust your sails. Don't be afraid to let go of underperforming stocks. Remember, it's not about holding on to every stock you bought. It's about maintaining a portfolio that continues to work towards your financial goals. But how often should you monitor and adjust your portfolio? Well, there's no one-size-fits-all answer. It largely depends on your investment strategy. Some investors prefer a more hands-on approach, checking their portfolio weekly or even daily. Others take a more relaxed approach, reviewing their portfolio quarterly or annually. The key is to find a balance that works for you, one that allows you to stay informed and make timely adjustments, but without causing unnecessary stress or making hasty decisions. And remember, the goal of adjusting isn't to chase after every market trend. It's about ensuring that your portfolio continues to align with your financial goals, even as those goals evolve. As your life changes, whether that's starting a family, buying a home, or approaching retirement, your financial goals will change too. And your portfolio should reflect those changes. Regular monitoring and adjustment ensure your portfolio continues to meet your investment goals. And with this proactive approach, you'll be well on your way to building a strong, resilient dividend stock portfolio that can weather any storm. Building a dividend stock portfolio may seem daunting, but with these steps, you're well on your way. We've touched on understanding what dividend stocks are and the importance of setting clear investment goals. You've learned how to select your stocks, focusing on companies that align with your financial objectives. we've emphasized the crucial role of diversifying your portfolio to mitigate risk and maximize potential returns. Lastly, we underscored the importance of regular monitoring and adjusting of your portfolio to ensure it aligns with your evolving investment goals. The journey to financial freedom is not a sprint, it's a marathon. It takes patience, discipline, and continuous learning. And remember, every investor started somewhere. You're not alone in this journey. Remember to subscribe to Cashflow Positive for more finance-related content. If you found this video helpful, don't forget to hit the thumbs up button. Until next time, keep your cash flow positive.